Take it away, Natalie.
All right. Well, thank you for joining us today, everyone, and welcome to our Q1 Market and Economic Update. My name is Natalie Adeback, and I am the Director of Communications here at Hub AFS Financial Group. And with me today as our expert speaker for today's discussion is Alp Adeback, the founder and managing partner of AFS. To share a bit of Alp's background, Alp received a BA in accounting from the Catholic University of America, and upon graduating, he immediately passed the CPA exam and opened a firm that focused on tax preparation and small business accounting. In 1988, he began offering his clients financial planning and investment management services as well. And in 2000, he decided to sell his CPA practice to focus 100% of his efforts on helping clients with financial planning and investment management. Alp's expertise is founded in that 36 plus years of experience in the wealth management arena. And if you know Alp, you are familiar with how enthusiastic he is about diving into discussions regarding the markets and the economy. Before I pass it over to him to do just that, I want to share the reminder to please ask questions at any time during today's session. You can ask a question by typing it into the Q&A link on your screen or through the chat function. And that should be located right on the bottom panel for you or at the top, depending on your view options. One of our favorite questions is, can I schedule a time to speak with your team one-on-one? The answer is always yes. I want to encourage you to directly follow up with this after today's session if you have further questions or would like to schedule a time to review a few things over Zoom or the phone. We love what we do, and the best part of what we do is connecting with people and helping them solve personal financial planning puzzles. So please do not hesitate to reach out. All right, take it from here, Alp.
Thank you, Natalie. And for those that are listening or going to listen later via recording, feel free to shoot myself or Jason an email with questions. I realize Jason is not on this call today. He is visiting family in West Virginia. So he sends his regards and he'll be on the next one. But Natalie is my sidekick for today. Key points to talk about today, the AI boom. And on that topic, I'll say one of the reasons the market has been moving higher, especially the tech stocks, when you listen to tech strategists talk on CNBC or Bloomberg, the ones that have actually been in meetings with Microsoft and Google and the various other companies that have a lot of AI related programs, they are saying that AI is transformative and it will be a major benefit for companies when they deploy it. So that's why I think there's a lot of buzz around it. A lot of times when there's like a new technology, you get like a nice rally and a bunch of things kind of pull back. Now, there's no question, just mentioning AI for some stocks brought them up to unrealistic levels. But the companies that are really behind it, they will benefit substantially from this AI boom. Subject of inflation, obviously inflation has been persistent now for coming up on 3 years now. And one example of how inflation impacts our lives, the other day I went into American Plant, a garden center in Bethesda, Maryland, and I had not been in there for a couple of years, and I was just looking for a few plants, and they had some hanging baskets. I was absolutely floored at the prices. Something I would have said probably 2 years ago would have sold in the $20 range. They had them all lined up inside at $48 each, and just tiny little plants were selling for $5 or $6. I'm talking about tiny ones in little 3-inch containers. Higher for longer. For the past year, everybody's been wondering how long interest rates, the Federal Reserve will hold interest rates at the level they are right now. And some people coin the phrase higher for longer, and that has proved right. The Federal Reserve, they keep talking about what has to happen for them to reduce rates, but they've been at a higher level for much longer than people anticipated. For a number of years now, the Magnificent Seven have driven the market action, and that's basically Microsoft, Meta, Google, Nvidia, Amazon, Tesla, and Apple. Right now, we're calling it the Magnificent Five. Tesla has sold off substantially and is nowhere near its highs, and Apple has kind of been moving sideways to down a tiny bit in 2024. So the tech rally has been driven by those 5 companies right now. I'll also talk a little bit and show you a few slides on the deficit and our national debt, clearly getting a lot more in the news on a daily basis. The divided economy, we've been hearing about this for a long time. We wrote simply, the rich are getting richer. If you think about it, stocks are at record highs, and real estate in strong areas actually is pretty much at record highs too, despite high interest rates or high mortgage rates. But one thing that I thought about the other night that has really benefited the wealthy, and I'm going to give an extreme example of, let's just say a wealthy person has $5 million in cash reserves, meaning money markets. 2 to 3 years ago, they used to get paid, like all of us, close to zero on that, or I'll say it's close, mathematically close to zero, because the banks just weren't paying any interest when the Feds had their zero interest rate policy. Today, the wealthy are actually earning 5.25% on their money market reserves. And if you think about that on $5 million, and again, extreme example, that's $275,000. I can guarantee you their inflation did not, their expenses have not gone up by that. So in theory, the reason the high-end consumer is still spending a lot of money, they're being paid to wait and have the money on the sidelines and are just getting paid large sums. And basically, it's one of the things that has hurt, I'll call it, the rest of the economy. If you're paying rent right now, rent prices have gone up. The wealthy own their homes, and if they have a mortgage on it, it's a very low interest rate mortgage. And if you have to finance cars or you have credit card debt, you're paying higher interest rates now. So again, we've seen this current interest rate policy really affect both sides of the economy. The obligatory disclaimer. And we thought it would be good to start with what happens to market returns around the end of a Fed hiking cycle. So the last Fed rate hike was July 26th, 2023. So JP Morgan came out with a great slide. You can see this down kind of like a third on the left, the last hike highlighted, that line going straight down. And if you take a look at these different periods when the Feds basically had their last rate hike, you can actually see history is on our side. Generally, rate cuts are to stimulate the economy. And so if you look at the prior periods when the Feds have had a higher rate policy and they started cutting rates, you can see for the next 24 months, the markets have generally done very well. Two periods not as well, 2004, 2006. That's basically right before the credit crisis. So there was some people starting to lean that way anyway. And in the aftermath of the tech bubble, 1999 to 2000, basically they cut rates because the economy just got way overheated. They had raised rates and they cut it because they just raised them too high. And it took a long time for the markets to recover, partially because the markets were up so much during that period. This is our normal first slide. This is basically the S&P 500 index at inflection points. And what I wanted to focus on here is the forward price to earnings ratio at different periods. So if you go to the far left, I did not highlight it, March 24th of 2000, tech bubble peak, forward price to earnings ratio is 25.2. And the way you calculate a price to earnings ratio, if a stock is $100 a share, and if the company earns $5 a share in profit, divide the 5 into 100, you get a price to earnings ratio of 20. A forward PE is using projected earnings for the next year. So the higher that number, the more expensive the market is or a stock is. So the S&P 500 in March 24th of 2000, forward PE of 25.2, that unwound substantially. And if you look at in the aftermath of the credit crisis, highlighted in the middle of the page, March 9th, 2009, forward PE ratio was 10.4. So the market was really cheap. And you fast forward to January 3rd, 2022, highlighted, PE ratio got up to 21.4. People were starting to get worried that the market was getting expensive. I'll point out it was nowhere near as expensive as it was in March 24th of 2000, but it was getting up there. Had the market sell off, and it basically came back to this trend line that we had and traded along it for a little while, which is a healthy sign. You were getting support there. And then the market started going vertical again. And right now, through April 8th, P ratio is 20.7. Things that we don't like about this chart is whenever you see a change in direction of a long, well-defined trend line, like you see in the aftermath of the pandemic sell-off, the market went vertical, a lot of stimulus got thrown into the economy. We did not like this. We thought it was an unsustainable trend line, and it proved to be accurate. And right now we're basically along those same lines as before. So the market rallied very hard off of that sell-off in 2022. Again, market's starting to get a little bit more expensive. And if you take a look at the 30-year average of that forward price to earnings ratio in the middle of the page, you can see market typically is at 16.65. Currently, as I mentioned, we're at 20.7 on the right side, but cheaper, as we mentioned, compared to the tech bubble. But one thing to point out, that we are basically considered one standard deviation above the normal range. And so what I like to say is the market's not crazy expensive. It's not cheap, and it's nowhere near the bargains that it was back in 2008. This is getting a lot of press these days. So this is the concentration in the S&P 500 index, which is a capitalization weighted index. And what that means is the largest company in it, Microsoft right now, gets the largest amount of every dollar that gets invested into the S&P 500. And so now the price to earnings ratios of the top 10 stocks, the largest stocks in the S&P 500, basically similar to what happened in the tech bubble on the left side. You can see it in green. The P ratios went up a lot. And if you come over to the right side of this graph, you can now see the same thing started happening again. Top 10 stocks, P ratio currently is 28.4, average 20.4. So we're selling at about a 39% premium. The remaining stocks represented in the black line, basically current PE is 18, average 15.7, just a little bit of a premium. And if you take a look what happened in the aftermath of the tech bubble, you can see that they basically traded together for about 10, 12 years. And then you started seeing the second tech explosion, and you can see the market started getting more expensive. People were talking about it. We sold off, but we did not completely unwind that premium like we did the last time. So that's an interesting change. Market seems a little bit stronger than it was in the aftermath. The economy, I'll say, is stronger in the aftermath of what happened in the tech bubble. But things that are starting to worry a few people is the concentration risk in the S&P 500. So if you look at the top right, the weight of the top 10 stocks in the S&P 500 as of April 8th, those top 10 stocks represent almost 34% of the index. And to put it in other words, the remaining 490 stocks basically make up only 66%. So it just shows you how top heavy it is. And we've seen how that has hurt market returns in downturns because those top 10 stocks tend to get hit a little harder because they've gone up so much. It pulls down the entire S&P 500 index substantially. And this is just a great slide that shows you this. So if you look in 2021, the Magnificent Seven stocks, they earned 40%. The rest of the index, basically excluding the Mag 7, 17%, overall index 27%. In 2022, the sell-off, Magnificent Seven took a beating, down 40%. Rest of the index was only down 8%. Big rally in 2023, up 76%. The rest of the index up a pedestrian 8%, and we're seeing a little bit of a repeat in 2024 through April 8th that the Magnificent Seven, and actually, as I mentioned, it's really 5 stocks that are driving that action, up 14%. The rest of the index, I'll say through April 8th, it's actually a great return. People would be very happy if the markets were up 5% 3 months into the year, but this just is an interesting slide to show you how much those stocks are impacting the overall returns of the index and really just driving the market action.
So Al, just for people who may have those Magnificent Seven and some of those top 10 in the S&P in their portfolios, what's kind of our standpoint or kind of the advice we're giving out when we see those kind of numbers and how high those are kind of selling at?
Well, so I'll say it basically kind of, the slide's a great example. If you have too much of it in your portfolio, if you've been aggressive, and typically it's more the younger population that gets really aggressive. Great Warren Buffett quote, only when the tide goes out do you discover who has been swimming naked, and meaning that they're not holding their defensive positions. And so if they're holding, just say, a big overweight to those stocks, they are basically going to feel it if we get a longer, more sustainable sell-off. It's hard to sell those positions. I mean, the reality is okay, I'll say it's easy to trim a tiny bit, hard to sell out of them completely because they have been dominating the market action. But again, just a simple reminder, make sure you keep your defensive positions in the portfolio, even though they are not performing as well. Like on down days in the markets, you'll generally feel good about it, or longer term down periods. I mean, one of the issues we've seen just in the last 4 or 5 years, any kind of deeper sell-off has been met with a really fast rebound. And so that's why it's been easier to hold them. And most people forget about the periods where, oh, I didn't realize it was down, those Mag 7 stocks were down 40% in 2022. I can tell you people were feeling that pain when we were getting phone calls. So this is a great slide by JP Morgan, S&P 500 market cap versus S&P 500 equal weight. So I already talked about what the market cap index is. There's also an index where the top 500 companies in the US that basically invest equally in each of the 500 companies, meaning Microsoft, the largest company, is invested in the same amount as the smallest, the number 500 company in the index. And so basically spreading the risk. And what this is showing you when it's in green, this is when the market cap is outperforming the equal weight, but up at the top middle, it's telling you that the equal weight actually outperforms 53% of the time. The market cap, and if you look at where this green on the left side, that's basically the first tech surge, the so-called tech bubble. A lot of outperformance there. In the aftermath of that, those tech stocks, the NASDAQ took a long time to recover. And I kind of showed you that slide where they kind of just trading along with the rest of the market. And then you can see on the right side, nowhere near as big of a bubble, but you can now see that the cap weight in green has outperformed. But during the pandemic sell-off and a few, I'll say in 2022 also, you can see that the balanced portfolios actually did perform well because they held up. This shows you a little bit more of just where the action is. So this is year-to-date returns. S&P 500 broken into large, I'll say US markets broken into large cap, mid cap, and small cap. Growth, blend, and value. So large growth are those tech companies. Year-to-date, they're up 10.6%. There's actually been a decent rally in, I'll say, everything else. Probably about 4 or 5 weeks ago, we were seeing the large cap growth up substantially and the value stocks were just up a couple percent. And so thankfully the rally has spread, which is very healthy for the markets. If you look on the left side, 10-year annualized returns, you can see growth stocks have dominated the value stocks, 16.1% versus value at 9%, blend being the actual index, or in like mid cap, if you see a mid cap value index, mid cap growth index, blend is basically the compilation of both of them. And so on the right side, if you take a look at the current price to earnings ratio versus the 20-year average. And so what you see here, large cap growth companies are currently selling at a premium to their 20-year average, 27.5 PE versus the 20-year average of 19. I will point out those large growth companies substantially more profitable than they were in the past. And so you'll hear many strategists say that they warrant a higher price to earnings ratio than they had in the past. Look at the value stocks, all much more reasonably priced in terms to their 20-year averages. And you can actually see it as a percentage on the bottom. Growth stocks selling about a 45% premium. On the opposite end of that, small cap value basically selling for their 20-year average, no premium, no discount, a little bit of premium as we move up to large cap value, but I would say that's normal in the kind of markets we're in. Probably 3 or 4 years ago, we were seeing some of these numbers pushing up like 170 to 180% on the growth side of the equation. Small cap growth, same thing. That's deflated substantially.
And now, can you just quickly touch on a few characteristics of what differentiates that kind of growth designation versus value, just to provide a little context?
Sure. I'd say on the value side, just think of all the dividend payers. Like right now, it's the energy companies, like the blue chip companies that, whether it's Procter and Gamble, Kimberly-Clark, Exxon, Chevron, et cetera, they typically are paying pretty healthy dividends. They're usually characterized as the value stocks. The growth companies, the Apples, the Amazons, the Microsofts, the Metas, Google, et cetera, Tesla, pay very small dividends. That's actually been just a recent change that some of them pay dividends, but they're very low in comparison. Typically a lot faster growing companies, where the value companies are much more stable, slower growing companies, profitable. The growth companies, again, on the small side of the equation, actually there's not that many of them are profitable on the smaller ones, which is one of the things that's hurt them in recent years. The big profitability has come on the large cap growth side. This is a good slide of a breakdown of what, and it's too many points on it, but we I guess a little rectangle, what you should be focusing on. So this is the S&P 500 broken down into 11 sectors, and you can see the columns. These are the different sectors in there. And basically, they've altered it a little bit. Tech is not exactly what you think. Tech holds Microsoft, Apple, and NVIDIA. Communication services right now, that holds Meta and Google, and consumer discretionary, Amazon and Tesla are there. But last year, when we showed you the large cap growth carrying the way, there was just a handful of those sectors that were actually up substantially. The rest of the market was struggling. A lot of it was down for the year, and clearly down for like through the first 10 or 11 months of the year. This year, the rally has spread out. So energy up 17.4%. Communication services being driven by Facebook, which is up substantially. That's up 18.7%. And they actually make up, some of these tech companies, since they're so large, they make up a big portion of these individual sectors. Like communication services with Google and Meta make up, I think, over 40% of that index. But on the positive, we're seeing the entire S&P 500 doing relatively well. Real estate struggling, so much more interest rate sensitive, and that higher for longer has been hurting the real estate sector. This is a great reminder of how normal it is to have pullbacks in the market. So this is S&P 500 since 1980, the gray solid bar chart lines. Basically, in 1980, that's where the index finished up the year. So in 1980, market was up 26%. The red dots represent the largest intra-year sell-off for the index. And so you can see major sell-offs along the way, even in years where the market has ended up positive. And you can see annual returns were positive in 33 of 44 years. But on the right side, I want to point out that year to date, the biggest sell-off is only 2%. And it's normal to have 3 5% sell-offs in a year. And so you can see last year we had a 10% sell-off. The market ended up being up 24%. But I also like focusing on, think of the credit crisis period. 2008, market was down 38%, at one point down 49%. Following year, it started off the year down 28%, but it rallied strongly. And so 2009 was actually a positive year for the market. And ever since the credit crisis, A lot of positive returns in the market. So, but remember, it's normal to have sell-off. So if we get a 5, 10, 15% correction, that's all part of normal market action. This is a reminder of how the US market has outperformed the international market. So the gray areas are when US outperforms, and so you can actually see since the credit crisis, US has substantially outperformed the international markets for 14 years. And again, most of this, hitting on the same point, is being driven by those tech names. The rest of the returns have been, I'll say, more pedestrian, kind of like the international markets, but those tech names have been so strong. We had a little bit of a period where we were getting some international outperformance that is now wound down, a little bit underperforming again, but they just kind of showed it to show you that we were cycling higher for the first time in a long time on the international side. But you can see this is why it's worth keeping some international exposure. There was a period in the 80s that international just substantially outperformed the US markets. And I have another slide coming up that I'll say kind of shows you how much the US markets now make up of the overall markets. And it gets a little bit of the global markets, gets a little bit worrisome at times. But part of it is just the strength of the US economy. And again, where all the tech leaders have come from. International valuations versus the US. So basically, international price to earnings ratios sell at around a 16.5% discount. So their markets have historically been cheaper. International markets are exceptionally cheap today. April 8th, selling at a 33% discount price to earnings ratios versus the US markets. And international markets actually pay strong dividends. On the right side, you actually get a higher dividend yield on the international investments, basically 1.7% higher. We always include a sleeve of international high yielding dividend stocks inside portfolios, especially for retirees. We'll put a larger sleeve in because it actually pays really nice dividends. We'll see some of those funds yielding 4, 4.5%, 5% just in dividends. This is that slide I was talking about, the share of on the top right, share of the global market capitalization. So what this is saying, the US now makes up 64% of the overall weight in what's called the MSCI All Country World Index. If you went back to 1987, it was a little bit over 30%, creeped higher, sold off a little bit, basically started getting higher, got up to about 50-something% in the aftermath of the tech bubble. Again, sold off. And then since about 2011, I was talking about how that US has outperformed. You can actually see just in a very easy to understand slide, US has dramatically outperformed. There are some people that believe this will change. I'm going to say that I'd like to see it first. And while we hold international exposure in portfolios, we're always, I'll say, working on lowering it to basically favor the US even more. Now, what's interesting for those that are, working with AFS 401k retirement services, if we're managing your company's 401k plan, and if you look at the allocations inside the target date funds, one fund family in particular, the Fidelity Freedom Funds, they are now running around a 45% allocation out of the equity allocation in portfolios. They're running 45% international because that's where they think the better values are. And they're basically placing the portfolio or focusing the portfolios with 45% exposure. Again, much higher than some of the others. You see a lot of them are like 25, 30, 35%. So they're going out on a limb thinking that international returns will be better over the next, I'll say, 10 plus years. A lot of opportunities in the fixed income markets these days. The Fed's higher for longer policy. You can take a look at what the yields are. I apologize. We've got the returns year to date. I should have also done it for the left side. That just shows you the various fixed income components, what the yields are. 2-year yield right now, 4.78%. These are treasuries up here. The 10-year US Treasury, this is actually up around 4.5% today, a little bit of a spike over the last few days with some higher inflation readings. 30-year, 4.55. These numbers were substantially lower 3 years ago. 10-year Treasury at one point got down, I think, below 0.7%. And so they've gone up. And so you can now get nice returns in fixed income. And so, for example, if somebody, had a portfolio of 10-year US Treasuries, they can lock in a 4.42%, for now 4.5% return, basically giving them higher returns than what we think inflation is trending at. And we'll show you in a couple of slides. And if you look at other fixed income, this is the US aggregate bond market yielding about 5%, corporates 5.5%, convertible bonds 7%, high yield 7.8, municipals, which are tax-free, 3.6. And so you can actually see that the returns in fixed income, just like money market yields, are up substantially. State of the economy. And so we're mostly talking about the US economy here. GDP growth. Long-term trend line's been about 2%. And after the pandemic sell-off where we shut down a lot of the US economy, we're back trending right along those lines. I'll say on a temporary basis, we've been higher than that. Most people believe it's going to slow down. And one of the reasons we've had some higher GDP growth is all of the, I'll call it extra stimulus, the Infrastructure Act, the various things that the government basically is spending money on right now. Obviously, some of it much needed on the infrastructure side, but some people believe that it's also, and not believe, I think it's pretty obvious, it's actually contributing to the higher inflation because they've thrown so much money into the US economy. This is just a reminder of what drives the US economy. And on the right side, you can see 67.7% is just consumer consumption. So that's the US consumers. You see government spending, investment ex housing, and then housing, but the consumer consumption drives it substantially. And some negative news. This is one of the things that I mentioned to talk about, starting to get a lot of press these days. The 2024 federal budget, $6.5 trillion. And to make ends meet, $1.6 trillion, a 24% deficit. So that is worrisome. And when you pile it on year after year, I think we're now at about 34 trillion in US debts. And the amount of time it takes to accrue a new $1 trillion of debt each year is at the shortest terms it's ever been. Again, this year, we're basically going to borrow 1.6. Some people have thrown out, they think that number's all going to be closer to 2 trillion. What's worrisome on the bottom right, federal net debt as a percentage of our gross economy, so as a percentage of GDP, you can see right now on the right side, we are now rivaling where we were during World War II, which we recovered very strong. The economy grew. And so the debt as a percentage of GDP went down. But then since around the year 2000, and I will blame both sides, we've spent like drunken sailors in the US, and our debt has gone up substantially. But what is really worrisome is probably 5 or 6 years ago, the forecast, this slide has always contained a 10-year forecast into the future. That used to go sideways. And now with all of the spending, it has moved up substantially. So quite the problem there. And if you take a look at what has been helping us out is the consumer, as I mentioned, makes up a lot of the US economy. Household debt service ratio. And if you think about this period, fourth quarter 07, we started getting big cuts in interest rates, and you can see everybody with homes refinance. If they had consumer debt, they pulled money out of their houses and paid off their debts. And so the percentage of debt payments as a percent of disposable personal income came down substantially, got even lower with stimulus payments during the pandemic and people weren't spending much money. And in the aftermath of that, people out and about, spending on their homes, it's still right back where it was. And if you think about that, that's mostly being driven by people having 15 and 30-year mortgages on their houses that are locked in. The rest of the world does not have the same setup as the US. If you look at a lot of Europe and Australia, they have variable rate mortgage debt that they were only fixed for 2 and 5 years. And that's why they've had substantially higher inflation there, because people's mortgage rates went up substantially. One of the problem areas right now flows into early delinquencies. So they actually track that. You can look at auto loans and credit card debts on the far right here, creeping higher. And the only reason student loan debts were flatlining, the delinquencies, they were not required to pay on their student loan debts, as you know, for a number of years. That just started up in the fourth quarter of 2023. So at some point, we're going to see this move up, because we've been hearing behind the scenes that people can't afford their student loans. Now, they've been fortunate. The government has forgiven a number of those. I think it's well over $100 billion these days. So that will help out on delinquencies. And I'm not going to touch that with a 10-foot pole of like whether that's a good or a bad thing. But this is what's going on right now. So a little bit worrisome. We are seeing delinquencies pick up. Unemployment and wages, and this is just indicative of a strong jobs market. So even after the pandemic spike in unemployment, you can see on the far right, got up to 14.8%. We have pretty much completely recovered to where we were. And so this has been one of the things that has been a problem in our economy, not enough workers. And for the first time in a long time, and you can actually see this from October 9th, 2009, when we started getting unemployment coming back down and kept getting lower and lower and lower, you started seeing wage growth go up substantially. Now, it spiked in the higher inflation years. It's come back down, I'll say close to the longer term averages, but this is what the Federal Reserve is looking at. They'd probably love to see this come in closer to 2.5% or 3%. But I will say this, one of the positives of higher wage growth is consumers spend money. So higher wages translates into a higher and stronger US economy. It's just another graph of just how strong the labor market, but I will say this, it's not as strong. There's not as many job openings as there used to be. So we're down about like 3.4 million in terms of job openings. And so market has cooled off a decent amount there. And we've heard for people switching jobs, the payoff is not what it was like, let's just say 2 or 3 years ago. And people are also worried now that if we do slow down in the US economy, they don't want to switch jobs and be the last person hired at a new company. Inflation, again, this has been a struggle to get it to where the Feds are trying to target. They are trying to get down to 2% inflation. They'd be happy if we got to about 2.5%. And they will start cutting rates, but that's probably the biggest, I'll say, wish list item for investors. They want to see inflation get into control, and they want to see the Federal Reserve lower the Fed funds rate. And so right now, this is what is worrisome to the Fed. If you look at the left side, this is history since 1974. And so what the Feds continue to worry about is what happened back in the 70s when inflation spiked up. They got it under control and then it reaccelerated again. And so that's their big concern. They don't want to see that. So you can see our spike on the right side, see the headline CPI in blue, and core basically, which excludes food and energy, which are considered much more volatile. Didn't get as high, but you can actually see both of them are, I'll say, much lower than the peak rates, but they've been flatlining around this area. And so the Feds want to see, they keep saying the same thing. They want to see a little bit more evidence that inflation is sustainable at these levels or lower, as opposed to that possible re-acceleration.
I wonder where the trend line for the plants would
Yeah.
fall in there. And Al, can you just quickly touch on kind of why that 2% number is maybe that magic area that the Fed is targeting?
Well, so the history behind that is actually an arbitrary number, believe it or not, but that's what they're focused on. And for them, they want to see a little bit of inflation, but they clearly don't want to see deflation, because that becomes problematic for people. If prices go down, but your debt levels stay the same and wages stay the same and don't go up, that becomes a recipe for disaster in the economy. So the Fed's always love to see a little bit of inflation. But if you recall, prior to this spike up in inflation, the Feds were doing whatever they could to try to get higher inflation. We were hovering around 1.5% with zero interest rate policy. They just could not get inflation higher. And then when you had the supply chain disruption in the pandemic and inflation took off, that ended up causing problems. So again, their focus is on that 2% target, but some people question, should they be looking at 2.5, 2.6, 2.7, and also realize that wage inflation, because of the shortage of workers, should be higher than normal, just pure supply and demand. Things that are actually contributing to some of the resurgence or flatlining of inflation you can see on this commodity prices, not just oil, but this is just a great slide on oil. You can see trend line, other than that big sell-off in the pandemic when nobody was using oil, you can actually see we keep setting higher highs. So if you see this from the left to the right going up higher, that's generally a sign of a more sustainable increase in oil prices. And the great Warren Buffett has been investing heavily in oil companies. He has, I think, put probably 15 or 20 billion in Occidental Petroleum, which, in his mind is just in a great place right now. And I think he thinks oil prices are going to stay higher. So it's not just oil, other commodities. I don't know if anybody's following what's been happening with chocolate prices, but cocoa. There's a shortage of cocoa right now. And so the prices have gone up over 100%. And so the higher end chocolates are feeling that. The manufacturers are feeling it. These are the components of inflation. And so the thing to look at on this chart, I'll just say, is how it's kind of been flatlining. This is on the left side. You can see it like hovering a little bit above 3%, but the main force of it has been shelter inflation. You can see the blue line on the bottom, and a new one. This is basically just started to be broken out. Auto insurance. For a little while, car insurance actually wasn't going up much because people didn't drive that much in the early days of the pandemic. And I think car accidents were down substantially. And now, since there was shortages in cars and car parts, if you get in an accident, it's costing more to repair. And so you've now seen that reflected in auto insurance rates. And this was never broken out. And so you can actually see a lot of inflation has actually come down substantially, but we're still seeing it be stubbornly high. Now, some people speculate that if they lower interest rates, home prices may not go up that much. And if that happens, housing becomes more affordable. And so it'll be interesting to see how that affects these numbers. Again, there's a lot out there that is just unknown. This is the Fed's interest rate policy. This just shows you the Fed funds rate along with the expectations into the future. And so I'm just going to go towards the middle of the page. This is our zero interest rate policy in the aftermath of the credit crisis. We raised rates 9 times. This is why I tend to think we're going to come back to lower interest rates at some point. Granted, I've been surprised we haven't already gotten down from the peaks that we've been at, but we went up 9 times in the aftermath of that. And we actually cut rates 3 times. So we were at 2.25 in the Fed funds rate. We cut rates down to 1.5 prior to the pandemic, and then we cut it quickly down to zero. And the mistake was we probably kept them too low when you factored in all of the stimulus that was being thrown in to the US economy. And so the Feds had to try to get in front of it, and they've pushed rates up substantially. What will possibly force their hand is the ECB and European Central Bank and the UK are talking about cutting rates now before the Federal Reserve. And so their economies have been slowing. And so if you see the rest of the world start cutting rates and there becomes a gap between their rates and the US, I actually think that will force the Fed's hand. So it'll be interesting to see how this plays out. I think the Swiss National Bank have already cut. So we are seeing some cuts to try to stimulate economies around the world. But in the US, we've been a little bit more stubborn. I actually think if they lower rates, it will probably alleviate some of the pressure we see in commercial real estate right now. This just shows you the trend line for US Treasuries. So this is from, I'll focus on the middle of the page, 1981 at the peak. You can see that interest rates kept getting lower and lower and lower. And this was a really well-defined trend line, and we broke above it. The question is, will this hold? If the Feds are forced to lower, interest rates, the question is, what will happen to things like the 10-year Treasury? And on that subject, when I talked about the Fed's ability to pay their debts, one thing to remember, the US 10-year Treasury and the various rates that the Federal Reserve is paying basically to borrow money, this adds a lot to our deficit. And so a lot of our debt is going to turn over the next 2 years, shorter term debt that they're now going to have to refinance at much higher rates. And so if our average rate goes up 2% and we're carrying 34 trillion in debt, I think my math is that's $680 billion just in additional finance charges for the US government. So that's why some people think that the deficit could get up over $2 trillion, and that becomes worrisome. Wrapping up a little bit here, when it comes to risk tolerance, I would just say that one thing to think about, some people, when they are in a strong market and they're seeing the so-called Magnificent Five stocks doing so well, they feel like their risk tolerance is higher. I like to get people to focus on how much risk they really need to take. And so if you think about it, if you're in the later stages of your career, getting close to retirement or in your retirement years, and if you've saved enough money for retirement, most people do not want to get caught up in a big market sell-off, or if you look at what happened in 2008, market was down 49%. If you've saved enough money for retirement, it's basically like running a marathon, 26.2 miles, and at the end of it, somebody's saying, run another one. So if you've saved, basically, and met your goals, if you don't need to take as much risk, and if you look at the fixed income yields that are available out there, you want to make sure you're reviewing what your risk profile should be, not what you think it is. Time horizon, it's the same thing. So, if retirement is right around the corner, you want to think about that. Or if you're saving for a specific goal, like if you're buying a second home, or you've got money that's going to be used to pay for college bills and they're getting closer and closer, you want to make sure you reduce the risk in those accounts, because if you've met your goals, you don't want to risk it. Final thoughts. What's next? I'll say we get a bunch of different surveys in the office, and actually a bunch of different newsletters. One of my favorite newsletters is the Bespoke newsletter. And last Thursday around 1 o'clock, they came out with something on investor sentiment, saying 2 different investor sentiment surveys they have show that the economy, the investors are too bullish right now. They were basically at historic highs, and they actually track this over 40 years. And what that means is people are putting more money in the market, more than they usually do, and their sentiment is higher. And as soon as that came out, the market actually sold off within 30 minutes. A lot of people get this newsletter. It's similar to whenever the newsletter comes out and says that investor sentiment is too bearish. Within minutes of that newsletter coming out, you'll actually see the market rally. So it's fascinating. I'd mentioned that the markets are creeping up in valuations, but I still think you have to stay invested. Now, I think it's okay to trim if you have now become overweight. If your equity exposure, if your target was 70%, you're now 75% because of the market performance. It's okay to trim out a little bit. If you're deploying new capital right now, I would say don't forget about just a good old-fashioned strategy of dollar cost averaging. So just buy in a little bit each month, and that way you kind of spread it out over good markets and bad markets. Talked about fixed income a lot. Bonds and cash remain attractive. One of the benefits of locking into longer term bonds, keep in mind when the Federal Reserve cuts interest rates, so if they ultimately cut 2%, that 5.25% Fidelity money market or Charles Schwab money market or Vanguard money market, that will go down commensurate with the rate cuts. So if they drop 2%, that 5.25% return will go to 3.25. If you bought a longer term bond, you're locking it in, or a longer term CD, you're locking in those returns for all those periods. And I'm going to only touch upon this next topic for a split second. I'll just say the election. If there's one positive about it, there are no surprises. Both candidates are known commodities. We've had 3 years of Biden, we had 4 years of Trump, so the market is not going to be surprised about what whoever the eventual winner is, what they're going to do with the US economy. So I think that's the one positive, and that's all I will say on that subject. Just a great message from our favorite investor, Warren Buffett. Be fearful when others are greedy. Be greedy when others are fearful. We've used this quote a lot. And one of the things to point out right now, Buffett inside his holding company, Berkshire Hathaway, or I'll say his operating company, sitting on record levels of cash right now. I believe over $160 billion of cash in his portfolio, not really deploying it in this market. This is our team. If you have any questions on the presentation, let us know. Shoot us an email.
Yep, I believe
Happy to help you.
contact info on the next slide as well.
But thank you, everybody. And if you would like a copy of the presentation, shoot Natalie a note and we will take care of it. Looking forward to getting together. Take care, everybody.
Thank you all. Take care.